Did you know that a single bank failure in Ohio could have changed the course of global history? In 1857, the collapse of an American bank triggered one of the first major international financial crises, catching the world off guard. The most extraordinary part? This panic spread like wildfire, shaking confidence in systems that once seemed unshakable. It sounds impossible, but this crisis shaped the future of financial markets in ways we still feel today. What really happened? And what lessons can we learn from this extraordinary event? Stay tuned and you'll find out. The global economy in the 19th century and the seeds of the crisis. In the mid-19th century, the global economy was becoming increasingly interconnected, with both the United States and Europe playing central roles in trade and finance. Capital flowed between continents, and any disruption in this interconnected system could trigger extraordinary ripple effects. Innovations in transportation and communication, such as railroads and the telegraph, expanded trade and financial markets, but also magnified the impact of any economic downturn. The economy was in a phase of exuberant optimism, where credit was easily available and many businesses overextended themselves. This overly enthusiastic climate set the stage for what would become one of the first great global financial crises. It was a clear reminder of the volatile nature of financial markets, where euphoria can quickly turn into panic. The banking sector played a critical role in this scenario, providing abundant credit, which initially seemed like an innovative and intelligent phenomenon. However, financial institutions like the Ohio Life Insurance and Trust Company were increasingly exposed to growing risks. The initial euphoria blinded investors to warning signs, such as rising debts and weak economic foundations. The collapse of Ohio Life was the spark that ignited a crisis that had been silently building for some time. When this major bank failed, it took many by surprise, but those paying attention realized the disaster had been brewing for quite some time. Ohio Life Insurance and Trust Company was one of the most influential banks of its time, with strong connections between New York and Ohio. Its failure, therefore, did not just affect a single region, but reverberated across the entire American financial system, shocking investors and businessmen alike. The magnitude of this collapse began to reveal the hidden risks in financial statements and poorly planned credit operations, which many had chosen to ignore until that moment. In the blink of an eye, what had seemed like a promising future turned into a nightmare. The chain reaction was inevitable. Ohio Life's failure created an extraordinary domino effect, with businesses and banks across the U.S. facing liquidity problems and insolvency. Panic gripped the market, sparking a wave of bank runs as people rushed to withdraw their money. Human nature, driven by fear of the unknown and uncertainty, amplified the collapse. People began pulling their money out of banks, fearing their savings would vanish along with Ohio Life. This, in turn, increased the pressure on the financial system. The crisis did not remain confined to the United States. As expected in an interconnected global economy, the consequences of this bank failure began to be felt in Europe, particularly in England and France, which had strong trade ties with the U.S. European banks, which financed American projects, began cutting their investments, worsening the crisis. The global nature of commerce revealed itself as a force for spreading crises, a phenomenon that would repeat itself throughout history. This event exposed the fragility of financial systems at the time and the lack of effective regulations to prevent the collapse of major institutions. The 1857 crisis was a wake-up call for understanding the risks involved in an increasingly interconnected world. The financial system, seemingly strong and innovative, proved to be fragile when the foundations of trust and credibility began to crumble. And it was only the beginning of a series of crises that would shape how we understand financial markets today. When we think of major economic crises, it's hard not to remember that many of them have roots in moments of unchecked euphoria and overconfidence. This cyclical phenomenon of high expectations followed by dramatic economic crashes has always been present, from 1857 to modern times. And without a doubt, history continues to repeat itself. The role of Ohio Life Insurance and Trust Company in the crisis. Ohio Life Insurance and Trust Company was one of the most influential financial institutions of its time, playing a central role in providing credit and insurance. Founded in Ohio, the company had strong ties to New York, the financial hub of the United States, acting as a key intermediary between investors and large industrial projects. Its collapse in 1857 shocked the economic system, revealing the fragility of a structure that seemed solid. This catastrophic event showed how even the most respected institutions can harbor deep risks and mysteries in their financial statements, something often only revealed during a crisis. What truly surprised many at the time was the speed with which Ohio Life went from a respected institution to bankruptcy. This led investors and businessmen to question the nature of business and the soundness of financial operations in a seemingly extraordinary economic system, but one that underneath was far more fragile than it appeared. The bankruptcy was a result of a series of poor investments and risky financial decisions, leaving the bank on the brink of insolvency. The liquidity crisis escalated rapidly, and the bank could no longer honor its commitments to creditors and investors. The crisis took the form of true panic, with people fearing they would lose all their savings. To make matters worse, Ohio Life had strong connections with New York's banking system. This meant that when it collapsed, many other banks also became exposed, creating a domino effect in the market. The global nature of trade, which depended on these banks to finance exports and infrastructure projects, amplified the consequences of the bankruptcy. Confidence in the financial system was shattered, and uncertainty gripped investors. The scene, once promising and innovative, was replaced by despair as many fled in search of safety. One of the great mysteries of this collapse was how the bank managed to hide its fragility for so long. Ohio Life had aggressively expanded its operations, investing in risky projects, many linked to the construction of railroads, which were seen at the time as the key to America's economic future. However, these investments did not yield the expected returns. The company became mired in debt and was no longer able to maintain its operations. This episode was a harsh lesson about the risks of uncontrolled financial expansion, especially when there is inadequate oversight. The effects of the bankruptcy were felt not only in the financial sector, but across the broader economy. Many companies that relied on credit and financing from Ohio Life were also affected and began to shut down. Unemployment soared, and the financial crisis quickly turned into a wider economic crisis. The interconnected nature of the economy became clear to everyone, and many began to question the effectiveness of financial systems that had allowed a single failure to cause such devastating impact. This extraordinary event was a true turning point. This crisis also raised important questions about the regulation of the banking and financial systems in the United States. Until then, there had been little or no supervision of banking operations, and many banks operated with total freedom, taking risky decisions without considering long-term consequences. Ohio Life's bankruptcy showed the need for stricter oversight and clear rules to prevent similar crises in the future. This was the beginning of a discussion that would take decades to result in more structured reforms in the American financial system. As the crisis spread throughout the U.S. and Europe, people began to realize that something was deeply wrong with the economic system. The panic caused by Ohio Life's failure showed the vulnerability of a system that depended so heavily on trust and easy credit. This extraordinary event marked a shift in how people viewed the financial markets, and its effects would be felt for many years. The next step would be to understand how the crisis was contained and what lessons it left for future generations. The panic in the United States and the public's reaction. When Ohio Life Insurance and Trust Company collapsed, panic quickly spread throughout the U.S. banking system. The crisis began to intensify as news spread across American cities, and confidence in the financial system, already shaken, collapsed entirely. People, gripped by deep fear and uncertainty, rushed to the banks in an attempt to withdraw their money, fearing they would lose their savings. This behavior, known as a run on the banks, is a natural phenomenon during times of crisis when fear outweighs reason, and people act en masse to protect their assets. The problem is that in such situations, the more people withdraw their funds, the more unstable the system becomes. On the streets, chaos was visible. Long lines formed at bank doors as rumors of more failures fueled distrust. The public, once confident in the nation's extraordinary economic progress, now found itself plunged into uncertainty and despair. The working class and the small middle class, who depended on their savings to survive, were the hardest hit. Many had placed their savings in banks that, until then, seemed solid and reliable. However, as Ohio life demonstrated, even the most respected institutions could be involved in risky, poorly calculated decisions. The panic revealed the fragility not just of the finances, but also of the very faith people had in these systems. The failure of a single bank had an extraordinary effect. Much like a stone thrown into a calm lake, with waves spreading in all directions, with fear taking hold, it was no longer just an economic issue, but also a mass psychological one. The fear of the unknown and imminent loss began to shape people's behavior. The financial system relied heavily on collective trust, and when that trust disappeared, collapse became inevitable. Interestingly, this cycle of financial panic would repeat itself several times throughout history, as a lesson that, in some ways, is never fully learned. In cities like New York and Boston, the impact was felt most strongly. Large merchants, businessmen, and industrialists also began to feel the effects of the financial collapse, as a lack of credit paralyzed businesses and investments. Many projects, especially in the railroad and industrial sectors, were abandoned or postponed, further heightening the sense of economic stagnation. It was as if the nature of industrial progress had been interrupted by an invisible but powerful force. Workers lost jobs en masse, and unemployment became a common reality in many parts of the country. This was the beginning of a dark period for the American economy. But not everyone was a victim of this panic. Some people, especially more experienced and astute investors, managed to profit from the crisis. While many were rushing to withdraw their resources from banks, others saw an opportunity to buy stocks and assets that had been devalued at very low prices. The nature of the financial market, even in times of crisis, offers windows of opportunity for those who can remain calm and act intelligently. This also generated a certain resentment among the public, who saw wealthy speculators growing richer amid the chaos, while ordinary workers and small investors bore the brunt of the consequences. The government's response, however, was slow and insufficient at first. At that time, there were no robust consumer protection mechanisms or intervention policies to contain banking crises. There was no institution like the Federal Reserve to act as a lender of last resort. Thus, the panic took its natural course, leading to the collapse of many other banks and companies across the country. The absence of a swift and effective intervention only worsened the situation, highlighting the need for structural reforms in the U.S. financial system. This crisis was one of the first clear examples that the government would need to take a more active role in times of economic instability. Over time, the crisis in the U.S. began to stabilize, but the impact on people's lives was long-lasting. Many families lost everything they had, and the economy took years to fully recover. The 1857 panic served as a powerful reminder of the volatility of markets and the importance of well-regulated financial systems. The panic may have subsided, but the lessons it left behind would echo for a long time, shaping how the government and private sector would approach future crises. The spread of the crisis to Europe. The crisis that began in the United States with the failure of Ohio Life Insurance and Trust Company did not take long to cross the Atlantic and cause havoc in Europe. At that time, the European and American economies were tightly interwoven, particularly through trade and the financing of large industrial projects like railroads. European banks, especially those in England and France, were heavily invested in American growth. When the financial panic began to spread in the U.S., the impact was quickly felt in European markets. The extraordinary interconnectedness of trade and finance meant that the collapse of one part of the system had far-reaching consequences. In London, the financial heart of Europe, market confidence began to crumble as soon as the news of the financial collapse in the U.S. arrived. British banks, which were heavily exposed to the American market, began to cut credit and halt new investments. This created a domino effect, where many British companies, dependent on the flow of capital, also faced difficulties. Railroads, the symbol of progress and innovation at the time, suffered a major setback as much of the financing for their expansion came from banks now in crisis. The natural curiosity and excitement about the future prosperity these railroads promised turned into doubt and fear of a larger collapse. France also felt the effects of the crisis, particularly in Paris, where financial markets began to crash. French investors, who had significant stakes in American companies, saw their assets devalue within weeks. The phenomenon of a global crisis was not something common at that time, and many were unprepared for how quickly the financial panic spread from one continent to another. The uncertainty that gripped European markets triggered a wave of mass selling of stocks and other assets, further worsening the situation. The interconnection between markets became evident, showing that economic stability depended on a network of trust and credit that was now crumbling. In Germany, while the impact was somewhat less severe than in England and France, the financial panic still hit the banking and commercial sectors. Many German banking houses had considerable investments in the American market, especially in railroad bonds and industrial companies. With the crisis, these investments quickly lost value, causing a devastating effect on local banks' balance sheets. The phenomenon of panic spread throughout Europe's major capitals, creating a climate of general distrust. This revealed something important about the nature of global markets. They are extraordinarily dependent on each other, and a collapse in one corner of the world can generate unexpected consequences in distant places. Meanwhile, European governments began to realize that urgent measures were needed to contain the crisis. In England, the Bank of England decided to raise interest rates in an attempt to stabilize the currency and attract capital back to the country. However, this measure had the side effect of making credit even more difficult to obtain, worsening the crisis for many businessmen and merchants. France also tried to adopt containment measures, but the lack of a solid regulatory structure at the time meant these attempts were insufficient to prevent a deeper collapse. This situation highlighted the lack of preparedness of governments to deal with large-scale financial crises. The spread of the 1857 crisis to Europe showed how the global financial interconnectedness could be both a blessing and a curse. While in times of prosperity, this connection accelerated economic growth and innovation, during times of crisis, it served as a conduit for spreading panic and instability. Railroads, international trade, and investments in new technologies, which once seemed like the path to the future, were now under threat. The psychological impact of the crisis was profound, and many investors began to rethink their strategies, avoiding risks and adopting more conservative approaches. The 1857 financial crisis, crossing continents and affecting entire economies, was one of the first significant examples of what we would come to know as a truly global crisis. This extraordinary event showed how markets, as they expanded in search of profits and innovation, also became vulnerable to large-scale financial disasters. The cyclical nature of boom and bust, and how quickly panic can spread, were lessons that would stay with future generations, shaping how governments and financial institutions would prepare to handle future crises. The impact on railroads and the credit crisis. Railroads were the great symbol of innovation and progress during the 19th century, connecting regions, accelerating trade, and transforming the economy. In the United States, the construction of new railway lines represented one of the most dynamic and attractive sectors for investors, both domestic and international. However, when the 1857 crisis broke out, the railroad sector was one of the hardest hit, revealing extraordinary vulnerability. Since railroads relied heavily on external financing, the credit freeze and financial panic resulted in the collapse of many railroad projects. What had once seemed like a future of growth and expansion was suddenly interrupted by a crisis of confidence and liquidity. The main problem was that many of these railroad companies were operating with large debts, relying on easy credit to finance their expansions. When Ohio Life Insurance and Trust Company collapsed, confidence in the banking system dissolved, and financing dried up almost instantly. This put railroad companies in a difficult position, as they had already begun projects and needed new loans to complete them. Without access to capital, many projects stalled and unemployment in the sector rose significantly. This phenomenon served as a harsh reminder of how economic development could be derailed by an unexpected credit crisis. The railroad crisis also had a profound impact on other areas of the economy. With railroad projects declining, demand for construction materials such as steel and timber plummeted. Entire industries that depended on railroad expansion, such as steel and lumber, saw their markets disappear overnight. The natural curiosity and enthusiasm for industrial growth gave way to uncertainty about the future, and many businessmen who had invested in railroad companies faced enormous losses. The interconnectivity between sectors became evident, showing how a crisis in one area could ripple through the entire economy. Another interesting phenomenon was how international investors reacted to the collapse of American railroads. Many European banks, particularly in England, had invested large sums in American railroad bonds. When the credit crisis began to hit railroad companies, these bonds quickly lost value, causing a devastating effect on European bank balance sheets. This extraordinary collapse was yet another example of how the interconnected nature of global commerce could spread the effects of an economic crisis. The psychological impact was as great as the economic one, with European investors becoming far more cautious about investing in the American market in the years to come. The credit crisis generated by the collapse of Ohio Life and the failure of railroad companies triggered an economic contraction that would last several years. Banks, which had once provided easy credit for these large projects, now became reluctant to issue new loans. This phenomenon, known as a credit crunch, occurs when the flow of financing dries up, even for businesses that were still viable. The lack of capital sank even more companies, which could not sustain themselves without new financing. Thus, the railroad progress that once seemed so promising turned into a minefield of debt and bankruptcies. However, as with many crises, there were opportunities for those who could see beyond the panic. Some shrewd investors began to buy shares in railroad companies at very low prices, believing the sector would eventually recover. This attitude, although risky, proved to be an intelligent one in the long run, as the market eventually stabilized and railroads continued to expand. The 1857 crisis was a lesson that, even in the most uncertain times, the cyclical nature of the economy offers windows of opportunity for those who remain calm and act strategically. Over time, the railroad industry rebuilt itself, but the 1857 crisis left deep scars on the sector and the entire American economy. The lessons from this crisis were numerous, especially concerning the over-reliance on credit and the need for greater oversight of financial practices. The collapse of the railroad sector during this extraordinary crisis was a reminder of how technological progress and innovation, no matter how promising, could be vulnerable when not supported by a solid financial base. The next great challenge would be to understand how the financial system could reorganize to prevent such a crisis from happening again. The government's response and measures to contain the crisis. Faced with the severity of the 1857 crisis, the U.S. government was under pressure to act and contain the damage to the financial system and the economy. At that time, government institutions did not have the robust intervention structure we see today, such as central banks or bailout policies for failing banks. Even so, the crisis showed the need for a more active role from the government in regulating and protecting the economic system. The collapse of Ohio Life Insurance and Trust Company and the ensuing bank panic was a shock to the authorities, who realized that extraordinary measures were needed to stabilize the situation. One of the government's first reactions was to try to restore confidence in the financial system, which had been completely shattered by the panic. This involved public appeals for people to remain calm and not withdraw all their money from banks. However, since the panic was already in full swing, this approach had little practical effect. People's fear of losing their savings far outweighed any reassurance the government could provide. Here, once again, we see how the psychological nature of a financial crisis can be just as influential as the actual economic factors. When confidence is lost, it's hard to restore it with words. Without a central bank to act as a lender of last resort, the government's options were limited. Even so, some emergency measures were taken to ease the pressure on banks. In New York, local banks began using government bonds as collateral to issue a temporary form of paper money, allowing them to continue operating despite the lack of cash reserves. This was an innovative and intelligent solution which helped prevent the total collapse of the banking system. Although it wasn't a definitive solution, it slowed the spread of the panic and gave banks some breathing room to continue functioning. The federal government, meanwhile, adopted a more long-term approach. U.S. Treasury Secretary Howell Cobb proposed some reforms to strengthen the economy, such as reducing import tariffs to stimulate trade. However, the impact of these measures was limited, as the crisis was primarily one of credit and confidence, and tariffs alone could not restore the flow of capital needed to stabilize the economy. The phenomenon of the credit crisis required broader solutions, but the absence of a centralized financial system left the government with few options. This highlighted the need for future reforms to prevent such crises from occurring again. The crisis also opened the door for broader discussions about the government's role in regulating the financial system. Many began to realize that the lack of supervision and adequate regulations had allowed banks like Ohio Life to operate recklessly. Without clear control mechanisms, banks could take excessive risks without worrying about the long-term consequences. The 1857 crisis was an important lesson in the need to regulate the financial market to protect both investors and the public. However, these discussions would take many years to result in real changes to the system. In the long run, the 1857 crisis was a turning point in the relationship between the U.S. government and the banking system. It was one of the first moments when it became clear that the government would need to play a more active role in overseeing financial institutions to prevent the collapse of a single company from having such a devastating impact. This perception would eventually culminate, decades later, in the creation of a centralized banking system designed to control credit and prevent financial panic. The 1857 crisis may not have immediately led to these reforms, but it undoubtedly planted the seeds for a more structured financial system in the future. By the end of the crisis, it was clear that the U.S. government, though it had tried some emergency measures, was still unprepared to deal with a crisis of this magnitude. The lack of a more effective intervention prolonged the effects of the crisis, leading to a recession that would last until 1859. However, the lessons learned were valuable, and the 1857 crisis went down in history as a milestone that demonstrated the importance of anticipating economic risks and having a more regulated and protected financial system against shocks. Now, the question was how the economy would recover and what could be done to ensure that past mistakes were not repeated. Economic recovery and lessons from the crisis. After the worst moments of the 1857 crisis, the U.S. and European economies slowly began to stabilize. The recession that followed the panic was long and painful, but as with many economic crises, the market eventually found ways to adjust. The extraordinary cyclical nature of the economy showed itself, with some industries adapting and others seizing the opportunities that emerged during recovery. Sectors that had been severely hit, such as railroads, began to reorganize and new sources of financing were found. This period of recovery highlighted not only the resilience of the economy, but also the lessons learned from the crisis. One of the first major lessons was the understanding of global financial interdependence. The 1857 crisis demonstrated how a single bank failure in the U.S. could trigger a collapse in various parts of the world. This phenomenon drew attention to the need for closer international cooperation on financial issues, something that was practically non-existent at the time. It was a harsh lesson on the fragility of the global economic system, planting the seeds for future discussions on how nations should handle crises that cross borders. Another crucial lesson was the importance of confidence in the financial system. The 1857 crisis showed that when confidence is shaken, panic can spread quickly turning a bad situation into a total disaster. To prevent this from happening again, many began advocating for the creation of mechanisms that could restore confidence during crises, such as a central bank that could act as an entity capable of providing liquidity to the system. Although this didn't happen immediately, the crisis was an important step toward greater regulation of the banking and financial system. Economic recovery also brought about a change in the behavior of investors and businessmen. The unchecked euphoria that had preceded the crisis was replaced by a more cautious attitude. Companies began to manage their risks more carefully, and many investors became more selective about the projects they invested in. The railroad sector, in particular, which had been the epicenter of risky investments, learned the lesson that rapid unchecked growth, not backed by solid cash flow, could be a dangerous trap. Thus, companies became more concerned with the sustainability of their businesses, something that would become a basic principle of economic development in the following decades. Over time, the U.S. government also began to reflect on its role in the economy. Although the government's immediate actions during the crisis were limited, it became clear that the state would need to take a more active role in financial regulation. The 1857 crisis led to a deeper understanding of the need to protect banking systems from future crises. Decades later, this would culminate in the creation of laws and regulations that would help strengthen the financial system and prevent new episodes of panic on such a global scale. Additionally, the crisis accelerated the debate over the centralization of the banking system in the United States. Until then, states had significant autonomy over their banks, often resulting in a lack of cohesion in monetary policies. The idea of creating a central bank began to gain traction, although this was still a long way off. The collapse of major banks and the fragility of the financial system during the crisis showed that the economy needed a centralized mechanism to manage crises and ensure system stability. This perception would pave the way for the creation of the Federal Reserve decades later. The complete recovery from the 1857 crisis took time, but the economy eventually returned to growth, and railroads, in particular, resumed their expansion. However, the crisis left deep scars on the mentality of investors, businessmen, and politicians. The lessons learned influence future generations, shaping economic and financial development worldwide. The extraordinary impact of the 1857 crisis, although devastating, served as a crucial reminder of the dangers of unchecked speculation and the lack of financial regulation. Now, history had shown that prosperity needs to be built on solid foundations, not on the fleeting euphoria of the market. The evolution of the banking system after the crisis. The 1857 crisis revealed an urgent need for reform in the banking system, both in the United States and Europe. With the collapse of Ohio Life Insurance and Trust Company and the failure of many other financial institutions, it became clear that the decentralized and lightly regulated banking model of the time was vulnerable. The absence of a central entity capable of regulating banks and intervening during financial crises was one of the factors that allowed the panic to spread so quickly. Therefore, this crisis planted the seeds for an extraordinary evolution in the banking system that would unfold over the following decades. In the United States, the crisis catalyzed a long-standing debate about creating a central institution capable of providing support during banking panics and regulating the flow of credit throughout the country. Although the Federal Reserve would not be created for many years, in 1913, the 1857 crisis helped shape the understanding of the importance of having a central bank. The need for an entity that could ensure financial stability in times of crisis became one of the most influential lessons left by the crisis. It was a lesson in the nature of the financial market and how it needs a solid foundation to withstand periods of volatility. Another significant change in the American banking system was the creation of the National Banking Act in 1863, a direct response to the 1857 crisis and the uncertainties that followed. This law was innovative and introduced several reforms aimed at increasing security and confidence in the banking system. Banks now had to issue notes backed by federal bonds, which increased trust among the public and investors. This was one of the first attempts to establish uniform banking practices, something that was absolutely necessary after the chaos caused by the financial collapse. Although it wasn't a definitive solution, it was an important step in building a safer and more stable financial system. In Europe, the 1857 crisis also prompted a deep reflection on the banking system. Central banks such as the Bank of England began adopting stricter policies for credit control and reserve management to prevent similar crises from occurring again. The 1857 panic had shown, in extraordinary fashion, how a lack of control over credit could generate a systemic collapse. England, being one of the largest financial centers in the world, quickly learned that tighter regulation and supervision of banking institutions was essential to prevent collapse during periods of panic. In addition to banking reforms, the concept of fractional reserve banking gained prominence as a way to prevent liquidity crises. The 1857 crisis demonstrated that many banks operated with insufficient reserves to cover the mass withdrawals that occurred during a panic. The practice of maintaining larger reserves in cash became a priority to ensure that, in times of panic, banks would still have enough liquidity to meet customer withdrawals. This brought more security to the system, reducing the risk of widespread collapse during future economic crises. The 1857 crisis also had a profound impact on the behavior of investors and banks. In the following years, a more cautious approach to credit and the financing of infrastructure projects, such as railroads, emerged. Banks and investors learned that rapid, uncontrolled growth, based on easy credit and speculation, could be a dangerous trap. The concept of financial prudence became a mantra, with banks rigorously assessing the risks associated with lending. This helped prevent similar crises in the following decades, although history has shown that, from time to time, the same mistakes are repeated. Finally, the 1857 crisis was a turning point for the global banking system. It highlighted the need for regulation, supervision, and a central entity to act during times of crisis. Although the evolution of the banking system took decades, the events of 1857 served as an important lesson on the fragility of the financial system and how it must be protected against panics and collapses. The extraordinary nature of this crisis was not forgotten, and its lessons helped shape the modern banking system we know today, with its more solid foundations and regulations, and a deeper understanding of the risks involved in the financial world. The social consequences of the 1857 crisis. The 1857 crisis had far-reaching social impacts beyond its economic and financial consequences, leaving deep scars on communities. With the collapse of banks, the failure of companies, and the ensuing panic, the lives of thousands of workers and their families were directly affected. Unemployment rose dramatically as businesses failed, and infrastructure projects, like railroads, were halted. What once seemed like a period of growth and innovation quickly transformed into an environment of uncertainty and hardship, especially for the most vulnerable classes. The extraordinary impact of the crisis revealed how financial events could upend entire societies. In major American cities like New York and Philadelphia, the crisis was felt most intensely. People who had once held stable jobs saw their sources of income disappear overnight. Many families who had trusted in industrial progress or invested their savings in banks that collapsed were left without resources and without immediate prospects. This created a wave of despair and, in many cases, resentment toward the financial system, which seemed to benefit only the wealthy while leaving the majority unprotected. The unequal nature of the crisis's effects highlighted the fragility of the social structures of the time. Additionally, the 1857 crisis had a significant psychological impact on the population. The confidence many had in the continuous economic growth and extraordinary progress of industry was deeply shaken. The fear of losing everything in a matter of days spread, and the public began to develop a distrust of the banking system and big business. This kind of sentiment is common during financial crises, when people realize that the systems they rely on for security can be more volatile than they imagined. Uncertainty grips society, and recovering from this loss of confidence would take many years. Small business owners, in particular, were severely affected. Many had taken out loans to expand their businesses, believing in the bright future of the American economy. When the crisis struck and credit dried up, these entrepreneurs found themselves unable to maintain their operations, resulting in a wave of bankruptcies. The credit crunch was ruthless, and the impact on these family-owned businesses was devastating. Many lost not only their businesses, but also their homes and savings, leading to widespread impoverishment in various regions of the country. This phenomenon highlighted the vulnerability of small businesses during systemic crises. Another significant social consequence was the increase in tensions between different social classes. The 1857 crisis heightened divisions between the rich and the poor, with many accusing bankers and wealthy investors of being the primary culprits for the collapse. While large businessmen, in some cases, managed to protect themselves or even profit from falling stock prices, the working class faced mass unemployment and a lack of basic resources. This sense of inequality, that the wealthy continued to thrive while the poor suffered, created an atmosphere of social tension that would resonate for many years. The crisis also provoked changes in how people viewed the government and the role of public policy. Until then, the idea that the market should regulate itself was widely accepted, but the 1857 crisis began to challenge that belief. People began calling for more government action to protect the public from market failures. Debates emerged about how the government should intervene during crises, creating social safety nets and support policies for workers. The transformative nature of this crisis paved the way for future reforms in the role of the state in the economy. Finally, social recovery was slow, and the scars from the 1857 crisis lingered for many years. American society, like European society, emerged from the crisis with a new perspective on the limits of economic progress and the dangers of an unregulated financial system. The social lessons of the crisis, such as the importance of policies that protect the most vulnerable and the need for a more inclusive economy, became central themes for future generations. And while the economy eventually recovered, the memories of this extraordinary collapse continued to haunt those who experienced its harshest consequences. The legacy of the 1857 crisis and its long-term effects. The 1857 crisis left a profound legacy that echoed for decades, both in the United States and the rest of the world. It was one of the first major financial collapses to have a truly global impact, revealing how the interconnectedness of markets could amplify a crisis. This extraordinary event marked the beginning of a new understanding of the nature of economic crises, showing that the effects of a single bank failure or speculative bubble could quickly spread between continents. The panic that began with the collapse of Ohio Life Insurance and Trust Company taught lessons that would shape future economic policies and the architecture of the global financial system. In the United States, the crisis was a turning point in terms of financial regulation. While comprehensive reforms, like the creation of the Federal Reserve, would come over 50 years later, the 1857 crisis was the first clear sign that a centralized banking system was necessary. The collapse showed how the absence of a central authority capable of providing liquidity and regulating banks made the system vulnerable to shocks. This realization spurred debates and paved the way for the eventual creation of financial institutions that would be able to prevent or mitigate the effects of future crises. The National Banking Act of 1863 was a direct response to these shortcomings, laying a more solid foundation for the American banking system. In Europe, the 1857 crisis also had long-term effects. European financial markets, especially those in England and France, which had been severely impacted by the American collapse, adopted more cautious approaches. The confidence many European investors had in the American market, which had previously been seen as a land of extraordinary opportunities, was shaken. This resulted in a contraction of international capital flows, and investors became more selective about where they put their money. The 1857 crisis helped solidify the idea that industrial progress and economic growth needed to be based on solid fundamentals, not just speculative euphoria. One of the most notable effects of the crisis was the change in how people perceived risk. Before the crisis, Unchecked optimism dominated the minds of investors, who often overlooked risks in pursuit of quick gains. However, the financial collapse of 1857 made both investors and businessmen more careful about the projects they engaged in. The railroad sector, in particular, which before the crisis had been seen as a foolproof investment opportunity, became a symbol of how uncontrolled risks could lead to collapse. This shift in mindset was fundamental in the development of a more balanced and prudent approach to financing large enterprises. Beyond changes in the banking system and investor behavior, the crisis also left an important political legacy. Society began to demand more from the government in terms of protection against economic crises and market failures. The idea that the government should intervene to prevent financial panics gained traction, although this concept wouldn't be fully implemented until the following century, with the creation of social safety policies and stricter regulatory frameworks. The 1857 crisis planted the seeds for a new understanding of the government's role in the economy, showing that government intervention could be necessary to protect the public from catastrophic financial collapses. In the long term, the extraordinary impact of the 1857 crisis also shaped how future crises would be managed. The lessons learned were fundamental to the development of policies aimed at mitigating the effects of financial collapses, both in the United States and Europe. The crisis served as a constant reminder that economic stability depends on a delicate balance of trust, regulation, and prudence. Future generations, especially after the Great Depression of 1929, revisited the events of 1857 as an example of how speculative euphoria could quickly turn into financial panic when there was no solid foundation to support growth. Finally, the 1857 crisis was a landmark event that helped shape the modern financial world. Its lessons about the importance of regulation, the need for swift responses during panic, and the dangers of unchecked speculation continue to be relevant today. The legacy of this extraordinary event serves as a reminder that while economic progress is essential, it must be built on solid and sustainable foundations, taking into account the risks involved and protecting the system from systemic failures. History has shown that financial crises can have a devastating impact, but they are also opportunities to learn and evolve, creating more resilient systems for the future. The 1857 crisis left us with invaluable lessons about the fragility of the financial system and how history tends to repeat itself. So, what will you do with this knowledge? Are you prepared to identify the signs of a market in danger? How can you apply these lessons to your own financial decisions? Think about it. And if you want to keep learning more about these extraordinary events that shape the world, subscribe to the channel and activate notifications so you don't miss the next content.